might not want to give up its priority by refinancing. I think the difference is, I think it's a little bit different where the bank who has the first also has the second. So in those situations, do you have, any of the banks have a program to try and help those mortgagors?
Yeah, I can speak to that. I think you had two questions there. All of us participate in the 2MP program, which is the Treasury's program on second mortgages. So if a servicer does a HAMP modification on the first, the note holder or servicer of the second must also perform a HAMP-like modification. So we all participate in that process. What we're looking at Wells is we're building up a team to take a look at looking at the debt holistically, and I think that's where you're going. And that is, if we do service both, can we take a look and bring the financials in once, not have the customer go to two areas of the corporation, review their financials holistically, and modify both at the same time to an affordable payment. And I think we're a few months away from that, but we've already started looking at that on notes where we do the first and the second.
Well, that's encouraging.
Mr. Ajachian.
Thank you, Mr. Chairman. Mr. Little, you mentioned affordable mortgages, which makes sense. You always want to ask the question, affordable to who, but I'm not asking that question. Is your affordability based on lower interest rate and longer years, or what's the formula there?
Yeah, I mean, we're all driven with HAMP in our own internal programs. I mean, HAMP drives, as well as Cal HFA, a 31% payment ratio. So that's the target we're using. At Chase, we use 31 as a floor, but we'll go higher on our own internal mods. Anywhere up to 40% payment ratio to try to get that borrower into a modification. So, I think I mentioned we try to achieve that with interest rate reduction, term extension, and then principal deferment, for the non-HAMP programs.
Thank you.
Chairwoman Torres.
I want to thank the four of you for, braving this hearing today. I heard that what you've said about the number of phone calls that are going out from each of your organizations over to the borrowers. And I've heard about the number of emails and text messages and form letters. And I've actually seen the form letters that you've sent out. I've been to some of your community fairs with Chase, with Wells Fargo. Haven't yet been to a Bank of America, but I've attended a lot of these community outreach events. I think I'm a little bit puzzled, and I want to ask you maybe to stop calling and start answering the phone, because in my community, what I am hearing, the complaints that I'm getting are that folks are calling, and this is my concern with the Make Affordable Home program, is that if my homeowners have to call the bank rather than Cal FHA to ask for a modification, where in that loophole, and when does their call get answered, and how will you be able to handle the number of calls that are being generated? And I know there are thousands of calls that are being generated by your emails and all of your outreach efforts. So add what we're doing on top of that. How are you going to be able to handle that volume of calls, and how are you going to be able to decipher which people you can help through these programs?
I'll take a stab at that one. First, the number of phone calls, the volumes. You're right, the volumes are large, and each of us have very large call centers that take those calls in.
But see, that's the problem, the call center, because my constituents call, and they have an 800 number, okay? So for whoever they're calling, number one complaint is they go through a general switchboard. Then they get transferred to someone else. And they'll talk to 6 people, and they're on the phone for an hour and a half before they actually get to speak to the loan counselor.
I'll address that from city's perspective.
Okay.
We do have the large call centers, and the phones get answered in well under 20 seconds, and the number of borrowers who don't get their phone answered is like about 1%. borrowers that reach us, all of our customer-facing employees have a desktop decisioning tool on their desktop. So if you were to call in, we would be able to qualify you real-time for the HAMP product. So we'd be able to tell you, yes, you qualify, explain to you the documentation be required to send in to start your trial plan. So we don't have a lot of transferring around of borrowers. The other gentleman all talked about kind of the relationship manager piece that they have, again, that to mitigate transfers. I think as an industry, if you looked at us, regardless of what I think public sentiment is, we actually do learn and we do listen. So that's why we have things like, a desktop tool for instant decisioning, relationship managers to help kind of mitigate those call transfers. We have centralized imaging that allows us to not lose documentation. I think a lot of the things that happened over the last couple of years, on some level, we were guilty of, and we've all have done a lot to increase our staff, increase their learning to be able to do exactly what you're asking for. And I think we've come a long way in that. Are we perfect? Absolutely not. And we continue to strive to get better.
So do you have dedicated staff to assist California homeowners on the one or two programs that you may be participating?
On the California program, because and I'm hawking everything from these guys. But on the California program, we have a dedicated group to work with Cal HFA. So they're working with a team of about 10 to 15 people for my organization that is directly working with all the hardest hit fund states. So there's a very good relationship that's established. And, again, the calls get answered or emails, however they want to contact us, and we're able to work with them.
That'd be the same for Chase as well. And just to add to the relationship manager piece, really occurs when a borrower phones in. Additionally, if one of our borrowers shows up at one of our events and talks to a counselor, that counselor owns them from that point forward. So same thing if they walk into a home ownership center, the counselor who talks to that borrower owns that relationship go forward. So, I think what my counterpart said here was true. I think if you've looked over the last 12 months, we've made many improvements in that regard.
Agreed. We're in the same model. Once you make it through the initial process, one of the things we've done up front is create screen pops. So if you're in California, and we can pop up on the rep and introduce the program and recommend that they call California and say the program is available now on that side. So it's a reactive basis. But once they make it through that initial process, we've actually moved to warm transfers, where I will actually transfer the loan directly to the counselor, introduce them, and give them their phone number, and have that single point of contact. So once you make it through the initial process, it's no longer an 800 number, it's a person's desktop.
So once you've gone through the first person and verified, your 10 phone numbers, your address, and where you work, and all of that, you don't have to repeat all of that information to whoever the warm transfer person is answering that call.
Yeah, that's correct, with a couple exceptions. The first person is going to try to resolve the situation with you. So let's just say you're only 30 days down in delinquency. You may be able to enter into a repayment plan, right? And they would be solved right there. If you get into that same situation again and you call back in, it's going to be a new person. The dedicated relationships are for folks that are in loss mitigation. They're looking at workouts, or they're looking at short sales. That's a much more extensive transaction that can take place. They stay with that person during the process from there. We also have the centralized hardest hit funds team as well. I think we've all done that. The other thing we've all provided is escalation points. So if the director or anyone inside the hardest hit fund program, they have escalation points if they have a customer issue, all the way up to me and above, if they need to escalate any issue through the process. And we provide that to all the states.
And Madam Chair, for the hardest hit fund programs, the intake for these programs really occurs with the state HFA. And the same is true with California. So for the unemployment, the reinstatement, and the transition assistance programs, all of that intake occurs at the state HFA level, the underwriting, the verification. Essentially what the state is providing to us as servicers is a data feed of the customers that the state has determined they want in the program. We really are not verifying documentation. We are, at that point, really engaging with the state on what the correct payment amount is to get that applied and posted correctly for the customer's benefit. There's no servicer incentives at all anywhere in this process. The money flows through be applied for the customer's benefit. Bank of America, like the other banks, also has a dedicated hardest hit fund staff. Our first team was located back east in North Carolina, and we built out a second team in Arizona that's closer, obviously, to this time zone, so we're transitioning the support on that level. With principal reduction, in the early phases when we roll it out on a pilot basis, Bank of America will be contacting eligible customers through an outbound HAMP mail solicitation.
Only eligible, because that has been the problem.
Customers that may be eligible, they will then need to apply to verify many things, including that they are owner-occupied and certain aspects regarding their income. Cal HFA's programs serve low to moderate income customers, so we've built that into our process to screen for that. Cal HFA also, as we continue to expand the program in the future from pilot to more full production, Cal HFA will also be intaking and referring customers for the principal reduction modification to Bank of America. So I don't want to say long term, but as we get more to medium term, really all four of those programs, a homeowner can pick up the phone and contact Cal HFA, go through, I think, what Cal HFA describes as a triage session with its intake center, and get decision for the appropriate program for them, and then Cal HFA would reach out to the servicer.
On the issue of the trial payments, if once they go through that extensive program and they're now in a trial monthly payments, some of the feedback has been at the end of the trial payment, for whatever reason, they don't qualify, or the modification was a temporary modification, and now they are having to pay back not only the difference between the real payment and the modified payment. In addition to that, they have fees and interest on late fees and interest on the shortage of the payment. Is that still happening?
I can address that. Now, you're speaking not of hardest hit, but you're speaking of HAMP program, I assume, as far as the
whatever
trial.
Modifications are happening.
When HAMP started, there was an urgency to get it distributed out to the country as soon as possible. All the major servicers implemented verbal income and expense discussions. That was allowed by Treasury in the interest of getting the program together. So what we saw was you would get a verbal opinion of the borrower's income from the borrower themselves, and that can include self-employed borrowers. We would put them on the trial according to their verbal stated. Then, 3 months later, we would get the verified docs in, look at it, find out the income and expenses were different, and then have to recalculate the workout. And that led to situations where we might have had to deny a customer.
Okay, these people I don't know about.
Yeah.
What I know about are the folks that have been a year long trying to get their loan modified, and they finally get there. They've already submitted or resubmitted, because every couple of months they have to send updated information, and they've been there. So you've looked at their W-2s, you've looked at their bills. Now you put them on a trial. In some cases, they've been foreclosed. In one case that I handled over the weekend, they didn't qualify because their home still had some value in it, but it was foreclosed at a much lower property value. So I don't understand, if you have all the documents and you pre-approve, having seen all the documents, why they would be asked to pay back with interest and late fees on a payment that you temporarily adjusted.
Well, I can't speculate on the particular case.
These are several different cases.
I can't speculate on that. For hardest hit funds, we've agreed to waive all fees associated with the loan during the period of the assistance. So there's no late fees, there's no NSF fees while we're receiving payments from any of the states. So it's not an issue. Everybody's agreed to do that through the U.S. Treasury. I am aware that early on in the HAMP program, trial payments could go 4 or 5 months as we ingested paperwork, struggled to get it, and struggled with the program. That has definitely occurred across the entire industry. I have not seen to the extent of a year. I haven't seen that behavior. Could it exist? Absolutely. But I have seen trials go past 3 months as we work to get information from customers to finalize the trial. I will tell you there's a solution now. Back in June, and actually we implemented in April, you now must provide full documentation up front. So we completely re-underwrite the loan up front, so there is no surprise. There's actually a non-event If you perform on the trial, we've already underwritten you, you're immediately flipped to the modification. That's dramatically reduced those situations.
Okay, that's really good to hear. On the issue of the two payments, so the maximum payment through a modification is $3,000. If the mortgage is $3,900, there was a recent article in the Sacramento Bee about a homeowner being refused a $94 payment because Cal FHA was making one payment worth $3,000, and the homeowner was trying to make up the difference. Have we resolved that problem?
What we've done as an industry, back in the fall, we worked with Treasury in all the states, and one of the things we agreed to up front was the servicers needed to receive a full mortgage payment for the entire month. All the other states that participate in hardest hit funds except California either accept a partial payment from the borrower and send us the full payment, or the state makes the full payment on behalf of the borrower. So on the unemployment program, which is, it's not a modification, it's the unemployment program. I just want to make sure we're on the same page.
Okay.
California is the only state that actually caps the monthly payment. We encouraged back in the fall that be taken a revisit, and instead use the maximum payment amount of $18,000. Pay the mortgage amount no matter what it is until you hit the $18,000 from there. And the good news is, because of the loan limit and the low to moderate income filter on the eligibility, the number of customers above 3,000 is fairly small, and it's a lot of times driven by their taxes and insurance payment. So I think if we can work through that issue, we can get there. Let me tell you what we run into is the IRS. So there is an IRS reg on the books, and the IRS is looking to change it. You cannot use government assistance and then deduct it from your taxes. You can imagine it finally made sense to me. You can't take a hardest hit fund payment that you receive from the state of California and deduct that from your taxes. The issue that we track with is if I receive a $3,000 payment from the state and the borrower pays me some other amount above that anytime during the month, I now have to do something that we do not do. I have to keep track of two different amounts, one that can't be deducted on their 1098 and one that can. I also have to go figure out how much of the $197 the payment the customer made is principal and what is interest. And that becomes a different issue because there's two payments. The other issue we encouraged is you don't know when the customer is going to pay. So if we receive a payment on the 1st for $3,000, the borrower could pay the 30th of the month. We share Chairman Ng's desire to make sure the funds flow out as quickly as possible. I'm sure that the director would not want to continue to make those payments if the borrower stopped. We would have to build an entire infrastructure to watch for that borrower's payment, go back to the state and say they've stopped paying, and then do a complete reconciliation of the payment amounts. So I think the solution is pretty straightforward, and that is let's adjust the program and work to partner together to do that.
Thank you for that feedback. Really appreciate it. Thanks.
Thank you. I'd like to just kind of ask this perhaps closing question, and this question is directed to Mr. Little, Mr. Merrill, and Mr. Bolton. You've heard Mr. Malavos indicate that B of A is moving very rapidly toward PRP. We have a situation where you have almost $800 million in solutions being offered to California consumers. Does not the fact that B of A is moving toward give you incentive now toward moving in that direction? Might we not see that as a basis for perhaps progress in that area? And if not, why not?
I'll go first.
And I just taking into consideration what you've already said about why you're not, because you're doing case by case and you've done other. But I want to. This is to me kind of a dramatic breakthrough that you have an institution as large as B of A who mirrors perhaps some of the same consumer base and financial considerations that you have. Does it not inform us that that's probably the way to go eventually?
Yeah, I'll start. I think you heard in my comments that we've already forgiven $2.8 billion of principal in the state of California alone. So we have a track record of using it. I'm optimistic that we'll be able to participate in it. In fact, right after this meeting, I'm going to be meeting with the director staff here while I'm in Sacramento to make progress on it. So I think we can work through it.
Thank you for that.
Oh, of course. I'm optimistic we can get there. I do want to make sure that I set your expectations because I think you know what they are. We can only influence 20% of the mortgages in our population. If you overlay the fact, that means 20 out of 100 loans. If you overlay the fact that 92% of those are current, right, and then you overlay the fact that a lot of customers may not be able to afford it even with the principal reduction, the population of loans that this will reach, I want to set your expectation, that's a smaller amount than everyone would hope from there. So we can only influence the loans that are on our balance sheet from that perspective.
Understood. But that's still progress.
Absolutely.
Yeah, additional comments for Chase. Again, we've used forgiveness on a targeted basis, and I mentioned some of the success factors before. What we're trying to avoid is the HAMP rollout where we were making changes every week for a year. That's not something that I think we want to live through again. So I want to make sure if this is going to happen, we do it right. To Bill's point about expectations, we ran our entire population of non-GSE modification underwriting decisions for 2.5 months through an HHF model, and I'll just tell you the additional impact of additional mods made was very insignificant. So we're taking all these things in. We want to make sure we make the right decision, but as we stand here today, we're not committed with a program yet.
But you're going to make that same phone call immediately after the meeting too, right?
What's that?
Mr. Bolton.
A couple of things. First, I think the one thing that kind of gets lost in this discussion is every single one of us is doing principal reduction through the HAMP program. So when you kind of go through the math that both of these gentlemen just went through where, there's a small percentage we can impact, that's kind of the portfolio that we manage, right, which is, for all of us, less than probably 20%. Then you factor in low delinquency rates on those, coupled by the fact that those who are eligible are first going to go through the HAMP PRA program, because that is kind of the established waterfall. It has to go through that first before we look for any of the state programs. It gets pretty watered down as to who has that availability to do that. Now, having said that, I think we're all open to taking a look at, is there a way we can fit the California program into our portfolios? All of our portfolios are a little bit different. From Citi's perspective, we took a little bit more of a conservative lending approach, and unlike these gentlemen, all their companies all kind of bought some failing institutions that had some loan products in there that maybe they wouldn't have originated, but they're now saddled with servicing. The biggest one being option arms. With an option arm, it's almost the only way to handle it through principal reduction. At Citi, we have 0 option arms in our portfolio. So we have a little bit of a different portfolio than some of the others, and that's why our use of principal reduction outside of the current HAMP principal reduction program is a pretty small niche, and we're trying to see if there is some opportunity there to do some more, but we'll probably do it more surgically than we would just kind of a wide vaccination approach.
Okay. Well, thank you. I appreciate the movement.
I'm sorry, I got one more.
Yes, I have one final question, and I'm going to ask Ms. Torres to conclude this section and move right in. Going forward, looking at the infrastructure, if you will, that Cal FHA has set up, do you have any recommendations on how they could improve their program vis-a-vis their interaction with your consumers, whether it be personnel, procedures, forms, staffing? Is there anything that would inform you that we could help them do a better job?
Well, I think, from Bank of America's perspective, we've really enjoyed working with Cal HFA, felt that they've definitely been a partner in helping to address the concerns raised from various perspectives and roll these programs out so that they can be successful in any large, complex project, not to mention one that utilizes federal TARP funds. There are going to be difficulties and challenges that both sides encounter, but I'm confident that we have the appropriate meeting routines and escalation points set up to work through those as we are in this pilot phase now, and then ultimately as we move forward into full production. So from our perspective at Bank of America, I think the infrastructure is there and the relationship is a healthy one that we can discuss issues as they may arise in the future.
I'd have the same perspective. One of the great things about 19 states being in the program. You've got a lot of best practices and learning capabilities, and we're very early into the program that everyone has an opportunity to look at all 19 states. They're not on board yet, but let's keep our eye on the ball with the 14 states that are live or with the pilot today and what's working and what isn't. So I think we'll be able to ascertain very quickly, as far as volume from each of the individual states, what's working and what isn't.
Thank you. I'm going to let Ms. Torres have the last word on this.
I want Caliphate Che to come up. I think Di Richardson is going to come up and clarify the issue of the two payments and how we can work together with the banks to ensure that we are doing everything that we can to assist our homeowners.
Sure. Thank you, Ms. Torres. This is actually an issue where, although we have a lot of love here at this table, this is someplace where we do disagree. Housing prices are significantly higher in California than they are anywhere else in the country. This is a program to help low and moderate income home buyers. We actually, when we created the program, believed that $3,000 per month was very generous. I would say that the gentlemen here at this table and their organizations, and including the GSEs, did agree in Washington that they wanted a full payment, no partial payment. But we do have some lenders that are participating that do accept a partial payment. So it is a possibility. We're also, we're taking a look as we have more knowledge, and once the program has a little bit more experience, whether we set that, at the right place. But wherever we set it, there's going to be a limit. I don't think it's realistic to think we would say it's going to be $18,000 a program cap and have the money last for 3 months and help an unemployed person for 3 months. We don't really think that's any type of assistance.
Okay, we will continue to work together on this. Thank you. Okay. All right, thank you so much for participating. I know that you flew in today, and I hope you enjoyed our fine weather here in Sacramento. We weren't expecting the rain, but, here it is. Thank you again for participating with us today.
Thank you.
I know it's getting late, members, and I appreciate you continuing to sit here very patiently. I will call our next panel. Pruti Visa of Community Reinvestment Director of the Green Light Institute, and also Jim Laurie, the Deputy Secretary, Farm and Home Loan Division of the California Department of Veterans Affairs. Thank you both for joining us.
Well, good afternoon, everyone. Thank you so much for having us here, as well as for your patience with this hearing. My name, as you heard, is Preeti Vissa. I'm the Community Reinvestment Director at the Green Lighting Institute. I'd like to thank Chairman Eng, Chairman Torres for holding this timely review of the CalHFA Keep Your Home California program. As you all know, we are witnessing an unprecedented loss of wealth in communities of color across the nation. For every 100 African American homeowners, 11 have either lost their homes or are at risk of foreclosure. For Latino families, the figures are worse. 17 out of every 100 homeowners are touched by foreclosure. These figures are even worse in California. CalHFA's Keep Your Home California has the potential to make a meaningful impact in the plight of California homeowners. Given the dwindling confidence in the federal HAMP program and the growing frustrations of struggling homeowners across the state, however, it is clear that the program must be aggressive in helping the widest range of homeowners today. Based on my observations, it is clear that 3 things must happen for the program to be a success. First, the program must be the most flexible of all foreclosure programs designed to help homeowners. Second, the program needs full buy-in from the largest servicers and the investor groups that own the majority of loans in the state. And finally, CalHFA must intentionally market the program to the very communities that have been hardest hit by foreclosures. So first, the Keep Your Home California program is just one of many initiatives set forth by the state and federal leadership to address foreclosures. Many of the other programs, such as HAMP, have already excluded a significant portion of borrowers in the state. In order to catch fire and engage the largest numbers of homeowners, this program must fill in the gaps created by existing programs. Our recommendations include the following. You just heard Mr. Merrill mention that with all the filters placed today, there are actually very few homeowners who would be eligible for the Keep Your Home California program. So what we would recommend is to perhaps have that first look where there is the common metrics you look through and you kind of get sorted through at intake. But for those who have been denied or disqualified, to have a second look with independent counselors who can then relook and see, are there other extenuating circumstances that would make it more eligible for this person to be involved. Second, of course, we just discussed removing the $3,000 cap for unemployment assistance, either raising the cap or eliminating it, but we know now that we're unnecessarily excluding borrowers from the program. And finally, we would love to require the servicers to utilize all aspects of the program, all 4 components, including the relocation assistance program for homeowners who do lose their homes. And I'll get to the principal reduction in a bit. Second, Keep Your Home California program is an important government initiative, but it can only truly succeed if it is accompanied by full buy-in and participation from the major servicers. Lenders must go beyond the requirements of the program and adopt a voluntary leadership commitment that makes California the leader in keeping distressed homeowners in their homes. A first step in this commitment would be for lenders to provide meaningful matching funds for the program devoted for principal reduction. They must also be equally willing to address second liens with the first home mortgages, and we thank BofA for their leadership on this issue. Cal HFA has a critical role to play in encouraging lender participation. It must be more assertive in clarifying and implementing the timelines for program execution and expenditures that can mitigate the crisis. Lenders need guidance regarding the urgency of the situation, and it is incumbent upon Cal HFA to provide some guidance. We really understand how much time it takes to really put this program together, but it's confusing and it's frustrating to know that funds were appropriated over a year ago, and yet we still have such low numbers coming through. And as we all know, that investor guidelines remain a major stumbling block to full implementation of the program so far. We encourage Cal HFA and the major servicers to work with community advocates to pressure Fannie Mae and Freddie Mac to have more flexible standards for their loan modifications. And third and finally, in order to generate the greatest interest in the program, Cal HFA and the major servicers must utilize ethnic media outlets as part of their marketing and outreach. In California, 2/3 of all foreclosures are among households of color and 1/2 among Latino borrowers. Without reaching out to borrowers in their own language and in the media outlets that they primarily use, we're losing the opportunity to reach the large population of impacted borrowers. We're hearing that so many efforts have been taken, 150 calls, 50 letters, but we also know that trust has been broken and we need to reach borrowers in the forums through which they're most comfortable. Second, we know that many borrowers, particularly those who speak English as a second language, use their local counseling agencies for support in navigating the loan modification process. Additional support must be allocated to nonprofit organizations that work with homeowners and oftentimes have greater rates of success. At present, we know that very few borrowers have benefited from the program due to the lengthy procedures for setting it up. However, time is of the essence for Cal HFA. With federal and state budget uncertainty and attacks on the HAMP program, it is clear that California must use these funds before we lose them. Success in California could quickly become a model for the nation, which urgently needs successful models due to the size and scope of the problems in our state. But this will require far swifter and more deliberate action from all of our stakeholders involved. So thank you.
Thank you.
Jim Lowry, Deputy Secretary of the CalVet Home Loan Program. Thanks for inviting us. When we heard of this program, we secretly got up and did a little dance around our desk. One of the things we learned was that we can't dance, but what we did learn is that this would help our CalVet homeowners dramatically receive federal money for the first time. To date, we haven't had any success in receiving federal funds in one way or another, so we've had to do it on our own to date. One of the things that we liked is we found that the group at Cal Housing were very professional and helpful. We loved working with them, and professional and helpful, that's generally not something that you hear in today's housing market. So we definitely enjoyed working with the group over there. But enough about them. Let's talk about us. We were skeptical at first about the program, and we didn't know if it would deliver the help that we thought was deserving to our veterans. But so far, the program is working as we thought it would. So right now, we're looking at stats, which I'll get to on the back page of this process, that I think you have in your handouts. So how did we start the process? We wanted to make sure that all our veterans were reached as soon as possible. So to reach our veterans, we assumed that there were two categories of veterans we needed to reach. The first were veterans with known financial problems, which we immediately called and made contact with. And the second group were veterans that were currently making their payments that we didn't know that were in financial trouble. So how did we get in touch with them? We were determined to educate all of our loan holders, regardless of whether they had financial trouble or not. So we made direct calls to known troubled loan holders, direct mailing to loan holders, notification on loan billings, and we also put it on our website. And then the last part is what about the results? So our program results, some say it's all in the numbers, and so the last page on your handout basically gives it all. To date, we have about 10,000 loan holders, and as of March 1st, 688 of those loan holders have called in to the triage. Of those 688, we have 42 in the Unemployment Assistance Program, 63 in the Principal Reduction Program, and 18 in the Mortgage Reinstatement Program. So we have about 123 borrowers in our 10,000 loans that have called in and have gotten through the triage prospect. And to date, and for this vintage of loan, we were losing approximately $90,000 a loan. What that will equate to in our program will be a savings of $11 million. And that's all I have.
Okay. Senator Mike Ing.
Thank you very much, Madam Chair. This is a chairperson's dream. No members to interfere with my questions. I had a question for Ms. Visa. First of all, thank you, and also thank you to the other organizations that were here today, the non-banking institutions. I was interested in your comments about how Freddie and Fannie have somehow set something that appears to be in concrete for the 80% of the mortgages that are underwater, 80% that are not able to take advantage of the program. How would Greenlining has a national scope. I know that you attended an event where you had former Chairman Frank in attendance. From that perspective, how do you convince the Fannie and Freddie and the GSEs? How do you influence that process? Who in Washington do you feel needs to be held accountable that has jurisdiction? Who are the regulators? Who are the elected officials that you feel need to do a better job? You don't need to name names, of course, but how do we? I guess let me just rephrase that. How do we accomplish what you are talking about?
Well, I think it would have been nice to have Director DeMarco here today, because I think he definitely would have his share of perspectives, and I think he's probably one of the greatest stakeholders to influence. Other thoughts, however, are that we have a really unique group of people in the room today. We have representatives from all of the major servicers, we have community advocates, and we have our local legislators who, if we got together and said in a united front to the federal government and to FHFA that this needs to be taken more seriously, I think we have much more added leverage. The other is, of course, that we tend to always look at foreclosures in a very focused manner, and we forget about the holistic perspective of the impact of foreclosures on the wealth gap, on unemployment, on the economic status of our communities as a whole. So when we make that argument, I think we're much more likely to understand that there are benefits to principal reduction beyond the however much the dollars that are reduced.
And then thank you. And my final question is, if I can, Madam Co-Chair, you've heard about the limitation on state resources, obviously, because of certain budgetary issues, and you saw that the Cal HFA program is limited in terms of people power. You've illustrated the fact that there's a tremendous need to do outreach into especially those language challenged communities. That's a concern that I have. What are some of the kinds of things that you and your organizations collectively in the state of California are doing and can do to help with the outreach, and how can we partner with you?
Sure. I think that just using the local counseling agencies, number one, is the best way to go. And I applaud, Di and Mr. Spears. HFA has done a lot in terms of partnering with anyone who's willing to come to the table. I do think, however, that, utilizing ethnic media not just through ad prints, but perhaps being very intentional about interviewing with them in terms of, Greenlighting has a network of ethnic media outlets, which we'd be happy to share, as well as the housing counseling agencies, who I'm sure would be happy to come to to an event or to meetings where we can create those sort of synergies.
Thank you.
Well, thank you very much, both of you, for joining us in this panel. Appreciate your efforts. I'll turn it over to you.
I believe we have a few hours left for public comment. So if anybody would like to address the dais, we certainly will welcome any participation. I don't see too many people.
I can't believe you're being shy. Okay.
Please.
Well,
I guess everything's been said, just not everyone has said it. So I think at this point I'll ask Ms. Torres if you will make any closing comments, and I'll add to that.
once again, I want to thank everyone who presented today and the members. I think it's a clear message to our banking industry that this is really a serious issue in our communities by the number of members that were here from the very beginning, that we are all committed to working with you to ensure that our communities finally become stable. Stability in our neighborhoods is our primary goal, not only because of property values, and we certainly want to ensure that they're paying their property taxes, as it was brought up earlier, but we want to make sure that kids are in their homes so that they're able to learn when they go to school. Thank you again, all who participated. Thank you, Co-Chairman Ng, for your commitment. We have had many meetings and lots of discussion on this issue, and I'm sure that we will continue to do that.
Yes, and I want to add and thank you, Madam Co-Chairman. They're all leaving after. Why is it every time I speak, people leave? But anyway, I want to also thank all the stakeholders for coming. You know, California has a lot at stake. Let's be clear. There's $2 billion on the table, 100,000 households that we want to serve. And please, let's work together to make sure that, you know, I think the last thing we want is to come back a year, 2, 3 years from now and say, you know, I wish we could have done it better. We want to partner with all the stakeholders, and more importantly, we want to know what the targets are. We want to know when those targets are falling short. We want to participate together in making sure that whatever needs to be done has to happen. That's really the only alternative. So thank you very much. I want to announce we will be having another hearing. The Assembly Committee on Banking is having a very comprehensive review of the new Dodd-Frank legislation, federal legislation. It'll be next Wednesday, the 23rd of March, and at 1:30, and you're all welcome to attend. I think we have a whole week dedicated to that discussion. But anyway, no, seriously, I enjoyed the comments, the members that were here, really good level of participation. And so hope to see you all soon. Thank you.